Hello, I'm Michelle Suskauer, and welcome to Insure Wealth, an exciting, informative, and important program. In this series, you're going to find out about wealth, what you work so hard to build and maintain for yourselves and for your families. And the man to tell you all about that is an expert who's been doing that for years, Howard Kaye. Great to be with you today, Howard.
Thank you, Michelle. It's a pleasure being here. You know, it's interesting. We named the show Insure Wealth, but it's really got two meanings to that title, because what we want to be able to educate people with is the idea that we can create wealth. People are able to create wealth during their lifetime, but as important as that is, how do they preserve their wealth? And I think Insure Wealth really captures that essence of what we're going to be discussing during the weeks ahead on the show Insure Wealth.
I love the name. I think it's perfect. And so let's get right to it. People work an entire lifetime to build up an amount of money they enjoy. But they find that when they put their hands in their pockets, whoops, there's another hand in there, the government, that can take about half of everything people have built just because they happen to make a mistake. Howard, what's the mistake? And how can people get the government to take less of their hard-earned money?
Well, it's certainly something that people do not like discussing, but we're talking about death. You see, the government requires everyone to pay an estate tax, a death tax, within 9 months following their demise. So really what we're talking about today is estate taxes, what's involved within estate planning, what the government does allow you to do, what they don't allow you to do, and everything in between.
Well, Howard, who pays estate taxes?
Well, really everybody does. The question is, are you exempt from paying taxes? Now, what does that mean? We are all given what's called a lifetime exemption. And we are given annual exemptions, which we're going to discuss later on during the show. But the idea is this, before I touch on that. When one passes away, the government looks and sees exactly what all of your assets are. This includes any cash, investments, whether it's stocks, treasuries, municipal bonds, CDs, money market accounts, mutual funds, your real estate, any extra items such as jewelry, art, a plane, a yacht, whatever it may be, any value that may be in a future investment. So once that's all calculated, then there's an estate tax rate applied to it. Okay. And that's what is to be paid. Now, I can already tell you're going to say to me, well, who is exempt
That's right.
from paying these estate taxes? Well, let's talk about the history just for a moment, because it's very important that people understand how this all came to be where we are today. Presently, there is a $5 million exemption. Now, once people hear that number, many things run through their head.
Right. I mean, is this annual, lifetime? I mean, people don't know. This
is what's called a lifetime exemption.
Okay.
Now, why do I say many things run through someone's mind? Because if you're told that the first $5 million of your estate is exempt, many people say, well, hey, this doesn't apply to me.
Right.
I don't have to worry about estate taxes. Not true. Now, if you're married, so let's use you and your husband as an example.
Okay.
You each have a $5 million exemption. So what that means is the first $10 million of your estate is exempt from any estate taxes whatsoever. So
Great.
If your estate is greater than $10 million, then you are going to pay taxes. But if it's less, then you will not pay estate taxes.
Okay.
Now let me take you through the history just for a moment. If we go back, let's say 25 years, and we have been educating people on these type of estate planning topics, utilizing life insurance, which we'll get into for a very long time. Back in the 80s, the exemption was $600,000.
Wow, what a big difference.
Big difference. So what that meant was the first $600,000 of your estate was exempt from estate tax, and for your husband, his $600,000 exemption was available. So $1.2 million between the two of you. Mm-hmm. Now, once your estate was worth more than that, there was an estate tax rate applied. Maybe it started at 25% and went to 30, upwards of 55%.
That's a tremendous amount. It's like you lose everything.
Well, essentially, you're right. People didn't realize that there was this heavy tax, and it really became prevalent back in 1981. And this is when the government gave us what we call the unlimited marital deduction. This meant that you can leave everything to your spouse, and your spouse can leave everything to you without any estate tax. But when the second person passes away and that money is left to the children,
then you get hit?
Then you get hit. That's when the estate taxes are coming due. So let's get back to the exemptions for a moment. We knew that they were $600,000. Now, as time went on, there was always discussion about raising these exemptions. Well, they were raised. They were raised to $1 million. And then when President Bush was in office, he created a program of an increasing exemption so that by the time 2009, I believe it was 2009 rolled around, the exemption was $3.5 million. In 2010, there was no estate tax.
Okay, at all?
At all. So people could freely die, and it's funny. Well, it's not funny, but we used to do seminars, and people would say, well, you know, we don't have to worry about estate taxes because the exemption is whatever your estate is. You don't have to pay estate tax. I said, show me in the room. Who wants to plan on dying this year to eliminate paying estate tax? So of course, no one raises their hand.
No, of course not.
Right?
Of course not.
So in any event, they had no estate tax. Then it was supposed to revert back to $1 million. So the benefit that people had in the early 2000s was now eliminated. However, what took place? What took place was that when President Obama, he extended the exemptions and turned it to $5 million.
Okay, which was so much more helpful, obviously.
Right. So we're going to be talking about two things during this show. Those that say, well, between my spouse and I, the first $10 million is free from estate tax. We don't have to do planning. Not true. And for those that are in excess of $10 million, they need to have tremendous planning done for them to help accommodating those taxes coming up.
So people really shouldn't be so comfortable, even though the number seems to be a very big number, which is $10 million, because there really does need to be some planning that needs to happen.
Well, there's planning that comes along any time tax law is changed, so you should always speak with your attorney or your tax consultants on these matters to see what changes may apply to your situation. We're just discussing the actual tax that would be due. Now, why is it important for people that are even worth less than $10 million? Well, number one, no one has a crystal ball. Nobody knows when they're going to pass away.
Right.
So the question is, if you have 20 years or 30 years or 40 years, you tell me then, what is the estate tax law going to be?
So it can just, we don't know when it's going to change.
We don't know. And it's obviously going to be dependent upon, well, where's our deficit? How much money could really be collected from estate taxes
What
ultimately?
president is in office?
What president is in office, absolutely. So all of these things make a difference. So since we're planning for today, but really for the future, you don't know what estate taxes are going to be down the road.
Right.
And I look at it this way. The first $10 million, like we said, is free from estate tax. However, if the exemption does reduce, the money that we can help create to offset the estate taxes just means that there's more money for your children.
And that's really the point, is it's just to protect everything that you have
for
the
you've
future
worked
and all.
For 70 years.
Right.
Not you.
Oh, thank you. Thank you. Not yet.
But our viewers.
I look very good for my
yes,
age. Okay.
Our viewers, they've worked for 60 or 70 years to amass the size estate that they presently enjoy. Why is it that they make a mistake and pass away, and the government takes half of everything they worked for? Now, in January, they extended this $5 million exemption. Now, this is very important because they said the exemption is now permanent.
Which is a really a big deal. So should people feel confident that it's permanent?
Well, after I heard this, the first thing that ran through my mind was, when has anything out of Washington ever been permanent
Right.
other than death and taxes.
That's right. So you didn't believe it.
No. And within the last few months, there has been talk about making it unpermanent, whatever the word might be,
Right.
and reducing it down to $3.5 million exemption.
So when people start feeling confident that they hear the word permanent, as you said, nothing is permanent.
Correct.
Nothing is permanent.
So therefore, that's how the tax law works with the lifetime exemption. So today, presently, you can give up to $5 million to anybody in this world that you want, and your spouse can do the same. And if you don't give it away during your lifetime, you can utilize it on death as the estate tax exemption.
Now, Howard, we want to hold on to and pass along as much as we can of what we have worked hard to achieve, but we want to follow the rules. So what can you tell us about how we can legally, legitimately offset estate taxes?
Well, we've already discussed the lifetime exemption. Now there's another exemption. Well, these are what are called the annual exclusions, or the annual gift exclusions, meaning that you're allowed to gift up to $14,000 a year to as many people as you want each and every year. So, what's the first way somebody can really avoid estate taxes? Give all your money away.
Right.
You can give $5 million to anybody plus $14,000 a year. You want to go collect 100 people a year and give $14,000 a year to each of them?
Go ahead.
You can do that. Obviously, this is not what people want to do. So what's the next thing? Well, you see, when someone passes away and the government says you have 9 months to pay those estate taxes, the question is, where will I get the money from? So during the estate planning process, typically somebody will meet with their attorneys and they'll try to set up various types of trusts.
Okay.
And within these trusts, they're gifting money during their lifetime so that the money is outside of their estate and it can accumulate outside their estate, so it won't be subject to estate taxes. There are other methods where people will set up a trust to put their home into, so that the home they can live in, but each year they're gifting part of it to their children.
So there are creative ways to do this.
There are creative ways, but I would say the bottom line when someone does meet with their attorneys is that the goal of estate planning, or what I typically say is the definition of estate planning is to reduce the amount of your estate, the size of your estate, by as much as possible, thereby reducing the amount of estate taxes due.
So how do you do that?
However, hold on one second. That's their definition. That's not my definition of estate planning. My definition of estate planning is very simple. I want to leave the most amount of money to my family and charity. And if that means I have to pay a large tax, but at the end of the day, I've created the most amount of money, that's fine, because I know what my goal is. My goal is not reducing the size of my estate to reduce the tax. It's to leave the most amount. So now you ask.
Okay, how do we do this?
How do we do this? Well, I will take you back 25, 30 years ago when we really started getting very heavy into discounting estate tax costs. And our mantra really was discount your estate tax costs by up to 90%. And the idea was very simple. People never heard these things, and we were getting telephone calls all the time for people asking, how do we accomplish this? Because we've now experienced it. That's really when it hits home. Somebody has a loved one that's passed away, a father, a mother, an uncle, an aunt, and they were the executor of the estate, and they experienced paying those estate taxes, and then all of a sudden there's this fear. I don't want that to happen.
Right, because that's painful.
With me, yes, very painful. Aside from the mourning and all, now I've got to deal with all these financial issues. So in any event, going back, we created a program saying we can discount the estate tax cost by 90%. But listen to the words. I'm not reducing your estate tax. I'm just accommodating the costs that are associated with the estate tax. So the idea was, as an example, a couple age 60 who were in good health, and I'm using numbers from way back when because I remember them, which stated the following. If you had a $10 million estate, and we assumed the estate tax was $5 million, we then wanted to have someone purchase a $5 million life insurance policy.
Okay.
Now, what was the cost of the $5 million life insurance policy? Back then, it was a one payment of $500,000 based on current assumptions. So what that meant was $500,000 is 10% of $5 million, right?
Right.
Well, if I only had to pay 10% of $5 million to create the money needed to pay the estate tax, I guess I received a 90% discount
There it is.
on my estate tax cost. So the bottom line here was that $5 million of insurance was created. Now, one of the most important aspects of this is who owns the policy, who has control over the policy. Now, you're a mother,
Yes.
you're married, and you have children.
Yes.
I would assume that at this point in your life, you're not ready to give control of your assets to your children.
Absolutely not. I have teenage daughters.
Okay.
I know where they're going to go with it.
And I would even tell you 20 years from now, 30 years from now, you still will not be in a position to give them control. Because just as my mother would always say to me, I will never be in a position of being beholding to my children.
Right.
While I'm alive, it's my money. I will give when I want to give, and I will hold back when I want to hold
So
back.
how do you retain control?
Well, interesting. In this aspect, you're not going to retain control, but you are in a sense. Now, what do I mean by that? There are two ways, really three ways, of owning the insurance policy. You can buy the policy, you and your husband, and own it, and list your children as beneficiaries. But that's pointless. Why? Because if you own it, even though the kids are the beneficiaries, it's part of your estate. So remember I said at the beginning of the show, the government or the IRS will figure out what all of your assets are. Well, guess what? If you're the owner of the life insurance,
It's an asset.
it's an asset.
Got it.
And that's part of your estate, even though the kids receive the ultimate benefit. So therefore, we don't want you owning it. The second way is you gift the premiums to your children, and they're the owners. However, if you do that, you may not feel comfortable because in one sense, they could say to you, well, we don't want the insurance. We think we're going to cancel the policy and take the cash value out. Now, it's very easy for a parent to make sure that doesn't happen. How? Kids, you do that, it'll be the last money you ever receive from Mother and I.
Right. So that doesn't sound like a good alternative.
The third and most appropriate way is utilizing an irrevocable life insurance trust.
Now, what is that?
It's a trust that you can name whomever you'd like as beneficiaries of the trust. You can also designate when and how they receive the money, whether you want a lump sum distribution, whether there are certain ages that you want to wait till your children reach before they receive that money, whether you just want them to have income from that principal.
So that means you would still retain control over how the assets are going to be
No,
delivered.
you have the control in the beginning when you set it up.
Okay.
But that's why it's called irrevocable. Once it's set up and you have an outside trustee, which there are many banks and different firms that act as trustees, once that's established, it can't be changed. That's why it's called irrevocable.
Okay.
But you set it up the way that you want. Now,
But the children still benefit,
Yes.
or whoever your beneficiaries
Right,
are
because
down the road.
in the trust, you might say, it's my 3 children, they're the beneficiaries.
Right.
When you and your husband pass away, the money is paid to this trust, and the trust distributes the money to the children. Now, you might ask, but wait a minute, how is the money used to pay the estate taxes?
That's right. How
Well,
is it?
It's not that that money is used. In theory, what happens is this. The estate has a tax that's allocated or accounted for, right? So now that we know that there's a tax, we need the cash to pay the tax. So the executor of the estate is going to look to see if there's cash in the estate. But typically, if it's assets, such as investments and things, the money from the trust that was created by the life insurance would be used to purchase the assets from your estate so that now the trust would have those assets. Now there's cash in the estate to pay the taxes.
So the life insurance company would be paying the taxes?
I don't want to say that the insurance company pays it, but effectively, yes.
Okay.
Why should your family pay these estate taxes when you can let a life insurance company do it for a lot less money than what your family is going to pay?
Well, that makes sense to me.
Now, who is this really important for? Take people that are small business owners. Take farmers in the Midwest. People that have illiquidity, people that are heavily in real estate, but they still have a large estate. Where are they supposed to get the money to pay the taxes? If they try to sell everything, well, then there's a fire sale. People aren't interested in that.
No.
So the life insurance is the easiest thing. I know people hate the words life insurance.
Well, it seems to be that there's negative connotations with that.
Well, because you have to die.
Right.
But aside from
and nobody wants to.
Nobody wants to.
Right.
But it's a fact of life. We're all going to die one day. And whether you buy life insurance or not does not dictate when you are going to die. So therefore, I'd rather pass away knowing I left as much as I could to my family. Because I got to believe that my children and grandchildren are all good because my family raised them. And I want to create for charity. Well, I can do that with life insurance.
Right.
So now we talked about a couple age 60 on what we call a last to die life insurance policy. Two people are insured on one policy. The payout is not until both people pass away.
Okay.
Now, age 70, that same couple, if they're 70 years of age, can buy that $5 million of insurance. Today, what is it going to cost? Maybe it's $1,250,000. But you've been around long enough. Tell me, where can you put $1,250,000 one time and create $5 million tax-free?
Well, let's talk about that. Let's talk about retirement funds. For as long as anyone can remember, people always said, put money away in retirement accounts. What's the difference between retirement accounts and life insurance?
Well, two very distinct differences. The example I just gave you of $1,250,000 going into a life insurance policy to create $5 million of coverage on a couple age 70, you would compare that to some investment that you might be going into, okay? Now, life insurance is not an investment. We can't call it investment. We did coin the phrase the investment alternative because I don't know what else to call something that you can put $1,250,000 to get back $5 million tax-free.
I call it amazing.
It's amazing, you're right. Now, since that is the case, the $1,250,000 that creates the $5 million is completely tax-free. We talk about retirement. This did not create income or anything else for you. What this did for you was just only accommodate those estate taxes. That was it. Retirement planning. Many seniors have IRAs, okay?
Right.
They may have had pensions and they rolled that money over to an IRA.
401ks.
Same thing. Now, they've amassed a tremendous amount of money. They don't need that money, but the government's going to require them taking distribution once they reach 70 and a half. So people like that, if they don't need that money to live, I will show them exactly how to distribute what their required minimum distribution is and utilize that to buy a life insurance policy to help accommodate the taxes, the estate taxes, or how to create much more for their families or favorite charities.
Well, do you have to pay both income and estate taxes on retirement money?
Yes, and that's what people don't realize. So your $1 million IRA at death is really worth about $270,000 to your family.
Well, that's a big shock, I think, to a lot of people
Absolutely.
who do not know this.
What I can show somebody, a couple age 70, is to take that million, break it, pay the tax. I'll have $650,000 left over, and with the $650,000, I'll create somewhere in the neighborhood of $3.5 million of insurance. Now, you tell me, would you rather have for your family $3.5 million, or would you want your $1 million IRA to be worth $270,000 to your family?
Oh, come on. Of course. Of course. You want the most that you possibly can get for your family.
These are the things, the ideas, the strategies that can be achieved with life insurance, but people just don't understand. And our job is to educate them, and that's the purpose of this show, Insure Wealth.
Well, let's talk about something that everybody loves to do, which is to give money to charity, to give to organizations that are near and dear to our heart. How's the best way to effectuate that?
Well, charity is a very interesting part of the estate planning process. Many people are charitable during their lifetime. They give on an annual basis. So let's take the couple that gives $100,000 a year to a particular charity. Well, is it that love for this charity only during their lifetime, or do they just love the charity that they want to make sure it's taken care of in perpetuity? Well, if that's the case, what should people do? Endow their gift. What does that mean? Create a $2 million life insurance policy for the charitable organization. It's tax deductible for you because you're going to gift the premiums there.
Right.
But with the $2 million, theoretically, that charity could create 5% of your income, which is $100,000 a year. So in the event, or not in the event, but when you both pass away,
Right.
$2 million goes to that charity to keep on that $100,000 annual gift. That's what insurance can do.
See, and I don't think that people think that way when it comes to charitable giving, but that makes perfect sense.
It does, as long as you're interested in philanthropy.
Right.
So the bottom line is there are so many things that life insurance can achieve. I know we've gone way overboard here time-wise as far as what other things can be discussed, but it's important that people understand, and they can certainly receive more information by going to our website or our telephone number, 561-417-5883. They can receive more information. And, of course, emailing as well.
Absolutely.
Because certainly we'll take questions here on the show and answer those questions for people at home.
So what are we going to be talking about next time?
Well, next time we will get into some, I don't want to say it's not estate planning, but to an extent it can be. We're going to talk about some income planning. We're going to talk about safety of capital. We're going to talk about accumulation, all geared for those that may not qualify for life insurance.
Howard, thank you so much for this very valuable information.
Oh, my pleasure. Thank you for having me today.
And that's Insure Wealth for this week. Thanks for watching, and we hope we've given you some real financial food for thought. Please watch us again next week at the same time. So long, and remember, for more information, 561-417-5883 or InsureWealthTV.com. See you next week.